Okay. Hello and welcome to part 2 of our little weekly series. Hi, Doug. Um, if you are, again, like Mark said, I was a market maker for 16 years. I've been basically trading options since 1989. And I stopped floor trading in 2006, basically probably 2 years too early, unfortunately. And since then, I joined Mark in 2000 and wow, I guess it was 11 now. Prior to that, I tried to, between my market maker life and my trading life and Option Pit, I actually joined a startup basically right around the financial crisis or prior to, trying to develop better software for trading. The company is still around, Bloomberg. It's now kind of connected to Bloomberg, but maybe something will happen with all that work. But that's what I did. And then eventually, I just came back to trading when I saw Mark's training program. I'm like, wow, it looks like you're trying to take market, kind of how there's like market makers have a certain technique, liquidity providers to sort of trading and managing positions. So what we've done is we've tried to take those ideas and make them essentially retail friendly, sort of translating, trading for vol edge to the retail space. And we apply it to different things. So in this case, we're applying it to the weeklies. There's a way to apply it to kind of iron condors, trying to take deltas, trying to buy premium, different ways to sell premium. We do a lot with the vol products. We're not going to talk about the vol products, at least I won't. We do other classes for that. That's literally that's almost a whole, that's a subject in itself. The fund that I helped Mark with, we just decided to start that to basically take all the vol trading that we've learned, and we're just trying to grow the fund. That's basically spending most of my trading time now outside of Option Pit is just focusing on that. And lastly, we will be starting is it the gold package we introduced gold, Tony, for volatility trading, essentially. So it's the vol products. There's trading volatility, which is basically what the gold course is, teaching you how to do that, use the Greeks to manage that. We'll do some of that here. And then we introduce the vol products there. We introduce VIX, we introduce VXX, UVXY. A lot of that we do pretty much every week in our chat room as well. And then there's the Platinum course where we do more on the vol products, and then eventually that's part of what we call the Pro, which is, it's about 8 weeks of that. So what we try to do is incorporate, we take trying to teach all the facets of how options work, depending on, if you take a 4-month class like gold, or platinum is more 6 months, pro is a year, where it kind of includes all of that stuff. But the gold class, we look at what we're doing today, the gold class helps sort of fill in a lot of questions you might have on how volatility applies to regular vanilla options, index options, and also the volatility products. Hopefully that answers the question. So the gold package gets you a long way on volatility trading in general. But I separate it into kind of vanilla equity and index options, and then just trading like UVXY, VXX, because all that stuff trades totally differently. It's related, but it's different. So what I have is a full-time job, and I'm trying to trade part-time. The gold class, yes. The gold class is set up, 80% of our clients, this is kind of how it works. We have 10% of our clients, I would say, are trading all the time. 90% have day jobs, and they keep our chat room open during the day. They kind of do their day job, and they kind of pop in and out. But the gold class is you take stuff. It's a lot of it's recorded, but then you have the live stuff every day, and we record live stuff, and we'll talk about it afterward. So the whole idea of the gold course is you can learn about trading options, but you don't have to trade anything. You just can sit and learn. You watch how all the trades work from beginning to end. And really the idea, I think, of trading options, and Mark would agree, is we're just trying to teach essentially pattern recognition. When volatility does certain things, when the market does certain things, you want to be able to respond to what's going on. So over time, you kind of learn what's happening. Okay, VIX is here. This is the stuff I need to do. Google's trading here. These are the things that could work, right? So it's not necessarily, we're not the place where you just, I think Google's going up, I'm just going to buy some calls, right? That pretty much anybody can do that. You just have to decide what you want to do, right? That's all risk management at that point. So what it is this is definitely a style and method for trading options based on volatility. Direction is always important because, you know, a lot of directional trades kind of become vol trades at some point, and a lot of volatility trades have a directional component. There's no question. But you want to learn how that works, right? So that's what our gold, platinum, right? Gold class is meant for beginners, Mel. Where the whole idea of the class is you go through it and you just absorb stuff, you know, and you can follow things. You follow a trade from beginning, right? The whole idea of Option Pit Live in the strategy letter, and I'll go through it at the end, is you want to learn how things work from beginning to end, right? Because we adjust trades, we either adjust trades or we close them depending on what it is. I know the basics, but the flies Mark was talking. Well, the thing with a lot of the fly trading is it's over your head, but the part is you've got to learn. So if it's over your head, that probably means you shouldn't be trading flies. And the next thing is you should learn how they work. The one thing about volatility trading in general is it's teachable. Meaning there's relationships, and that's what I'm going to do here. All right? And then all this stuff about the other questions will go on because I want to get going. There's a lot of material. I have two examples, SK, in this class. Okay? But again, going through examples, I go through hard examples in this one. But that's what we do in the chat room kind of every day. All we do in the chat room is examples. Endless repetition of examples. Okay? All right, let's get going. All right, option pit disclosure. The materials presented from option pit, blah, 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 using data. Basically, I'm not reading all this, but it's here. Trade at your own risk. Understand what you're trading. Okay? This is for educational purposes only. All right? Hopefully you're going to see I'll have 3 examples, I think, today for you. Okay? This is a very example. So first off, why using weeklies in the first place? The concept of weeklies is a sentiment indicator, right? We're going to spend a lot of time on weekly time spreads, I think, and what the reasons why is the weeklies lend themselves well to time spreads. Okay? Most of the reason why I talk about them is because they work really well as a time spread. Understanding term structure to your advantage. Trying to choose the right type of calendar. Time spread and calendar, same things. The risk and short premium trades, Mark covered that a lot, but the one reason why we look at time spreads or calendars and weeklies is it's a much easier way to control risk of a position. And last thing, we talk about a what I'll say is kind of an option type position, which is a slider, is it's a time spread with a hedge. Okay, which is essentially a trade that a position a liquidity provider would have on much bigger, but is sort of the retail oriented part. Okay. If you don't understand any of this, that's good, because that's what the class is about. Okay. So the first thing is, what's a time spread anyway? Okay. You're buying a back month option and you're selling a front month option. We'll go over exactly. But essentially, the risk chart looks like this. Okay, now Mark just showed you a butterfly chart, correct? Yes, no? Thank you, Trevor. Where basically you make money if the underlying stays here. You lose money if it moves too much. Is there anybody who does not get that about looking at a risk chart like this? Or everybody, half the class is afraid to say so. That's okay. Many of you I know do. Now here's the next thing. What's the biggest assumption about this chart that the platform is not telling you? Mike says does not account for IV. That is correct. It's not telling you the implied volatilities are going to change. This is a static look. It's not telling you Mark talked about skew, talked about implied vol. They're not giving you any inkling that vol can change. Now, some of you that were watching the activity on Friday, right? What did VIX do on Friday? Right, it went from 12 to almost 15, right? That was a massive relative move for VIX. Okay, that means options near the money probably changed in the SPY, probably changed by 50 cents from the low to the high. Okay, 30 days out. So the idea of time spreads are, the first thing is it's a risk-controlled trade. Number one, you can only lose what you buy, pay for. The second part is it might have a delta, all right, as in long or short, you can control that. It has some sort of short gamma, meaning you don't want the underlying to move very much, right? That's what this says. I want the underlying to stay in a range. The red line is today, and this kind of what we'll call the magenta line is September 1st. So it's giving you an idea sort of how the performance, essentially how the position is going to decay. It's got a positive theta number, which is 31, meaning it's going to decay theoretically at $31 a day. Okay. What is also, these are basically what's called the Greeks. And this is also telling you that if all the conditions stay the same, you should expect to get about 31 bucks a day. Okay. Lastly, the vega of the position, meaning the exposure to a change in volatility is around $25 per volatility point. Okay, so all I'm doing with this slide is you're framing the fact that we're actually net long a little bit of volatility, exposure to volatility, but we also don't want the underlying to move. So a time spread is, right, and this is, we're talking specifically weekly time spreads, right? So this class is very narrow for that, is in order for this to make money, anytime you buy a calendar, certain things have to happen, okay? They absolutely have to happen, okay? Which means the underlying can't move too much. Usually, if it's priced right, not much more than outside of one standard deviation. And two is you don't want your implied volatility to go through the floor, right? So there's certain things you have to look at for weekly calendar. Okay, and that's what we're going to go over. What are the things that are going to make this thing pay? Right? Because everybody wants to sell premium, right? Sit on their back deck, drink a cup of coffee, and make money, right? Want to quit your day job and just do that. Okay? It's not that easy, right? But it is possible. Not coffee. Okay, gin and tonic, a glass of wine, whatever you like. Okay. All right. Well, you can sell premium, but right, you got to be careful. Right. A lot of the better traders that we have at Option Pit, they still sell a lot of premium, but it's always in some sort of risk control fashion. And they wait. This is what you're going to learn about, time weeklies is there are going to be better times to trade weeklies. That's what we're going to go over, right? You want the market to kind of say, hey, now pay attention to the weekly, depending on the product you trade. Okay? So there's a couple things about weeklies in general. It is these options reflect market sentiment in the most immediate way. Okay? That's the easiest way I can describe that. The weeklies are telling you what the market is thinking. So the first thing you want to be able to do is understand what the market is telling you already. Okay? Anytime there's a change in implied volatility, and I'll ask this question, does somebody not understand what implied volatility is? Right? All right, that's all right. I'm just trying to pull this at the money up right over here. There we go. Okay, so what you have to do is you have to see the story that the options are telling you. Okay? Basically, the differences in implied volatility per month is where the story is. Okay? What the market's telling you the story is. And that way what you can do is start to position, and you can look at putting on a weekly trade that has a chance to pay money. Okay? So here's a couple things that we'll go through, right? Each weekly term has a different implied volatility, meaning the volatility of one week is different from another. And I've got some examples for it, but I want to kind of set the stage here. The degree that they're different we call basically the sigma of the option, meaning every weekly term, right? So we've got September 2nd, we've got September 9th, okay? We've got Sep 16th, the ordinaries. Every term has a sigma is basically, let's just call it an average volatility for the term. Okay? So if you're a thinkorswim trader, where is the sigma in thinkorswim? Okay, the sigma's right here on the right. 1216, 1233, 1320, 1357, 1390, 1352, all the way on and on and on and on. Okay? It's also telling you that that sigma is generating a standard deviation on the right. Okay? So the important thing about the information is the market you always want to, where you can, basically digest the information the market's giving you. Right now the market's saying we've got an average 12.16 volatility. That implies a $2.90 standard deviation for basically the SEP02 cycle that was on the close on Friday. Okay. Now, the difference is what makes it interesting in if you have disparity in weekly term IVs or in sigma, okay, the more certain the market is about what's going on. Like, well, Andrew, what do you mean by that? Okay. So what I want to show you here is, now look at this last phrase, it's kind of important. The greater the disparity in the weekly term IV, the more certain the market is about what's happening. Is there anybody that actually understands what that means? Thank you, Stan. Let's talk about it a little bit. Right. Mike's saying the variance in the sigma column. So if they are similar, more of the same. So he's saying the greater the disparity in the weekly term IV, the more certain the market is. Meaning, if you have a certain shape to the curve, and we'll go over that in a second, the actual slope of the implied volatility sigmas per term are trying to tell you something. Okay? In this case, you've got SEP 23 is we got 2907, 2702, 2624, 2675, 2878. Can it be just a big player's opinion? Possibly, but not normally. Right? Because generally, having a big player, and I can describe volatility, but a vol surface works like it's a cocktail napkin, essentially, right? You put the cocktail napkin down on a table, right? And the big volatility player is basically like your fingers picking up the cocktail napkin at that point. Do you understand the image? So if the guy is really buying options, right, you're going to pull it up at that strike and the vol surface will pull all the way up. If somebody's really compressing those options, imagine that you're pulling the cocktail napkin through the table. Do you kind of understand the image? So it will work in and out depending. That's sort of how volatility spreads across the surface. What's important here is Tesla here is a little bit jaggedy, meaning if we look at this as an idea, the disparity in the weekly terms, there's not a lot of, right? There is not, I would say, a lot of disparity in the weekly terms in this. We'll talk about it a little bit later. Okay? What I want you to notice is, now these are expiring these expired Friday, so you kind of take those out of the equation, right? There's a little bit of vol difference here. The September 09 is lower, mostly because this is the holiday, right? But one thing you notice, if you take this holiday out, right, because you have 1 day gone, so this vol should be lower, right? If you take this holiday out, notice that the 02 is lower than the 2702, lower than the 2797, lower than the 2923. Does everybody see that? This is lower than this, is lower than this, is lower than this, right? So if you go back to this, the greater the disparity in the weekly term, the more certain the market is, meaning if I'm pointing down like this, right, and I have some disparity as in differences between volatility, the market is more certain that this near-term vol should be low and the longer-term vol a little higher. So I'm going to give you a graph of this in a second, but the idea is when you look at a sigma chart like this, right, you want to see what that's actually kind of telling you. Right now the market's thinking this near-term implied volatility is low. So if you think near-term vol is low, I'm not expecting a lot of movement. The market's not expecting a lot of movement. Okay? You think, well, Andrew, why is this one lower? And this is lower because you're losing a day because of the holiday. That's the way implied volatility works. You take a day out. Volatility is a function of time. Takes the implied vol lower. So what this term structure to me says is that in the short term, the market's not expecting Tesla to move very much. And there's a big reason why that is, right? Because there's a 45-day period for Tesla to buy SCTY. There shouldn't be a whole lot of movement in Tesla during that 45-day period. that is reflected in the options, right? So that is telling you something. It's not leaning bearish, John. What it's leaning is it's not moving very much. Okay. Generally, charts that are kind of in this contangoed shape are actually, it's not that they're really bullish. Does TOS allow you to plot the sigmas on a chart? What they do is they do give them to you right here. I just went over that, right? So if we take Tesla on TOS, right? Okay. 26, 27, 30, 30, 31, 32, 34, 41. Do you guys see that? Okay. It's not as convenient because this is laid out. I know the guys that developed, they used to trade in my pit in San Francisco that developed this. This was developed how liquid, like a market maker wants to look at things. Okay. So the skew is pointing down. You take away this one, the farther out the expiry, the higher the sigma. That's right, because remember, volatility is a function of time, Tom. You go farther out in time, the volatility should be higher. Okay, so this is the important part about term structure, right? Okay, what you want to do, and especially with the weeklies, because we'll talk about when we start to narrow this a little more, you want to understand the risk that the market is sort of telling you is going on. Okay, so if I imagine each one of these numbers, if I plotted these numbers, okay, if we plot these numbers. Now, in the case of Tesla, I'm getting rid of the August 26th because that expired on Friday, right? Because very near-term options that are 1 or 2 days or 1 day away, the implied volatilities are going to look very high because the Vega per point is very low, and I'll explain that when we go toward the end. But what I just want you to notice, for the most part, is this is kind of, we take out the SEP 09 because of the holiday, right? If you put the holiday back in, it's probably closer to 2680 or so, 2690 for vol, if we put that trading day back in. So this is lower than this, is lower than this, is lower than this, is lower than this. So the slope, what is the slope for Tesla? Is it the green one or is it the red one? Right? What's the sigma slope for Tesla? Is it the green line or the red line? It's like the matrix. Do I take the blue pill or do I take the red pill? Or is it the green pill? I can't remember. It's the red line. Okay. What does the red line mean? Right? The red line means the market in generally is quiet, meaning you're not expecting a lot of realized vol. Okay? Not only are you not expecting it, but money is betting against it. Okay? So right here, if I go to the left side here, this is the nearest term option on the left. If I move all the way to the right, that's the farthest term. Does that make sense, Mauricio? He's asking where. Okay. Okay. The gray line is what we'll call a flat vol. Okay. Flat vol is essentially, I don't know what the hell is going on. Okay, so you have the market's doing nothing. Gray line, I don't know what the hell is going on. Green line is market on fire. Anything is going on. Okay, does everybody get that? So when we were in like February of this year, what is the X and Y axis? Okay, so the X axis, right? The X axis is time, right? This is this term. Remember, that all I'm doing is taking this volatility and I'm plotting it, right? So the X axis is the term, right? And the Y axis is what? The sigma number. Does anybody not get that? Did I answer your question now, Tony? So if I said February of this year, what did the term structure, the weekly term structure of the SPY look like? Was it the red line or the green line? Everybody has to guess. February of this year, VIX was 40, 30, whatever, 29. Green line or red line? If you don't guess, you're not learning anything. Blue. Thank you, Frank. Longtime clients are not allowed to be smartasses, but that's okay. I feel sorry for your patient right now. I think they just got the green pill. You're right, green. So all you're trying to do is look at the weekly term structure, right? And get a sense of what's going on. Is everybody kind of clear on the concept that this is, again, just looking at what the market's giving you? So for the green line, sigma starts off high and then decreases further out. That is correct. Right? This is also like the term structure for the VIX. Okay, so if you had to guess right now, you know what's going on with the market. Is the term structure for VIX the green line or the red line? A lot of reds. So you guys see this? Right? So now let's pull back for a second. So if you think the market's really going to move and you think the stock's going to really rip, right? Red is more typical contango-like structure, absolutely. Most things are in contango most of the time. So when they come out of contango, right, then that makes us interested. Because what you're looking for is, I drift out of contango, and if there's a trade there on a weekly, and it drifts back, right, that is potential for me. Right, so meaning, right, where's my paint? Okay, there we go. Okay, so I've got my little trade. Oh yes, it is covered in more detail in the gold course. But I'll cover it in more detail here too, Tony. So if I've got a curve that looks like this, okay, and it's just popped up there, right? If I can sell options here and buy options here, right, and they're going to move, if I expect a little bit of reversion down to here, which is kind of the normal way of things, maybe, or something like that. Whoops, undo. Okay. Right. Now all of a sudden my short option has dropped a bunch, right? And my long option has only dropped a little, right? So if you're buying this and selling this, there's some potential for you to make a little dollars, and we'll talk about how that works, right? But one of the assumption is this red line is how the market is most of the time. This is a state that things revert to, meaning not much is happening. Eventually the curves go this way. The good thing about the weeklies, right, which makes the weeklies an interesting trade, okay? So if you think there's money between green and red line, right, the good thing about the weeklies is they spend a lot of time doing what? Right? If I'm giving you a class on weekly time spread trading, what do you think the weeklies spend a lot of time doing? Right? You get a little bit of activity. No, you get a little bit of activity, the curve jumps up, the activity dies, and then it falls. Does that make sense? So this part of the curve is actually kind of active, right? The market moves a little bit, the implied volatility pops up, market stops moving, implied volatility drops. Right? That's what makes the weekly time spreads interesting. Okay, because if there's no way to capture dollars, then we don't care. So when he's asking when the curve reflects the market, that could be the market for an index, an ETF, or an equity. Is the red the difference between the sigma? Yes. Okay. So when I did this let's say is a sigma of here 19, and let's see. Anyway, 19 here. Let's say it drops to 15 here. Okay, and here you're like 17 here. Okay, and here you're only really dropping to like let's say 16. Okay. All right, so you get a big drop here, small drop here. Okay. Now let's look at some examples. Okay. Here's the SPY and here's Tesla. The reason why, like we looked in our chat room this morning, nobody really liked the idea this week, but that didn't mean I didn't keep track of it all week long. I tried to steal $1.15 for the Tesla time spread that I'm going to look at, and I never got full because I thought it was really cheap. It traded probably down to 120. Okay, so what I try to do is, we'll look about it here, but I want you to see, right? Okay, there is, in this particular case, you got a little bit of an upslope curve because of the holiday. Okay, so if I buy this SEP09 and I sell this forward one, I'm expecting that SEP02 to do what? The volatility to do what? Right. So if I buy this one and I sell this one, what do I want the SEP02 implied volatility to do? Oh, yeah. Sorry about that. Don't want to do that. How about that? Fall. Exactly, Trevor. Exactly. Okay, that's what I'm looking for. Okay. So I had a specific plan, right? So think of it this way. When you think about this trade, if the SEP02 volatility gets very high, what's that going to do to the cost of my time spread? Let's say the SEP09 volatility is stock still, not moving, but the SEP02 vol gets really high. It starts to blow up. What's that going to do to the value of the time spread? Is it going to make the time spread worth a lot more or a little more? Close, Frank. Remember, value of the time spread. If the front month volatility is moving up, is the time spread worth more or less? Tag says less. Frank says less. People confused. Is there confusion? More is not correct, Adrian. But you had a 50-50 shot. Greg, are you confused? I need a drink. Watch. Okay. So we're going to put on this time spread here. Okay. I'm going to buy the 220. Okay, so we're buying SEP. I want to buy the 9, and I want to sell the 2. Okay. Right now it's printing $1.60. Remember, my price I was looking for to purchase was about $1, $10.15. Couldn't get down there. Went to 120, I think, the low. But that week won't go up by itself. Vol will rise, and the longer duration will go up more. Well, not necessarily, but I'm giving you a specific instruction, right, Frank? I'm telling you the back month vol is not moving, and the front month volatility is going up, right? Remember, I'm speaking in absolute terms. So if we have our spread, right, because this is essential to understanding how the weeklies are going to trade, right? Because if you don't get this part, then you're going to have a hard time trying to do anything, right? I'm going to take the volatility in the front month up 10 points. Okay? Do you see how I just lost $1,200? Okay? So if I have 10 spreads, I'm losing $120 per spread, right? So that just dropped the value of this thing to 40 cents. Does everybody see that? If I'm losing $1,200 on 10 spreads, that's $1.20 per spread. If I paid $1.60, I just lost $1.20 per spread. So as that front month vol goes up, the cost of my time spread goes way down, right? Does that make sense now? You're going to lose money, right? So if you paid $1.60 for it and the vol blows up in the front, what's going to happen to you? Right? You're the bin of sadness. Exactly. If the option you're selling goes up, the whole thing gets cheaper, Dave P., but you lose money, right? Kramer's House of Pain. So if you're looking, so now this is a thing. So when I was a liquidity provider and I put stuff on at $1.60 because a customer wanted it, and then the front month volatility blew up, I got sad, right? I got very sad because all of a sudden the market blew up in my face. Dennis is saying, but if it stays below the strikes by week's end, yeah, you certainly, I'm not saying you can't make money, right? But don't you want to understand why you're losing it? So I'm just telling you guys, if you put this spread on for $1.60 and the vol blows up, you're going to have a negative mark to the tune of $1,200. You guys got that? Now though, but now the thing is, instead of putting it on $1.60, why don't you wait till the spread gets down to 40 cents? Right? So instead of putting the spread on in the red zone, wait till you're in the green zone a little bit. Okay, so the idea here is, and I'll show you how the pricing moved when this kind of the front got bid up. It was the same thing with the SPY going into the weekend. Another thing we talked about in the pro chat and a couple other places is just I couldn't get anybody interested either, and I was kind of lukewarm on them. But you did have some decent term structure again here with the SPY on the 25th. This term started to jump a little bit again. Right? So again, waiting for the implied vol to go up first before you take action later. The difference that a retail trader has that a liquidity provider doesn't is they have the opportunity to pick their entry point. Okay? Right? So if you're going to trade the short-term time spreads, right? This is a weekly trading class. You want to wait for what? You want to wait, right, from contango to backwardation. So if you just trade the SPY or you trade the Qs or you trade the Russell, which is, or some of the, I would say, more liquid ETFs, this is really a strategy where this works okay. The reason why I'm picking Tesla right now is because Tesla is in kind of a strange place, meaning normally I would not do this or find a protected way to do this in Tesla. If you expand on the thing with a retail trader is you can wait till there's backwardation before you do something, right, Stan? A liquidity provider, I've got my markets out there all the time. I just got to, my edge is the bid offer, right? As a retail trader, though, you can wait till things get to a price. Wait till it gets interesting. And then add your time spread. Do you see what I mean? You have the luxury of waiting till the pricing gets interesting. What I mean by that specifically, waiting till the term structure, if you're going to trade weeklies, gets to a spot. But it doesn't always spike. Well, there's two things. Could it spike higher? Sure. Anything can happen anytime. But part of trading time spreads, especially if you trade the SPY, is you also need to start to understand how your product works. It's very hard for these time spreads to get totally out of hand as far as pricing goes. You want to wait till they get to a spot. Okay? And at the end here, I'm going to show you how to manage the risk of the position. Okay? So what I want to show you now is all of a sudden you're seeing we have 1039. The distance here between these two strikes here was roughly 80 cents. Okay, the distance here now dropped to 22 cents in volatility. Right? Well, remember, you have to thread the needle. So you had a compression on here of 60 cents, which is a pretty big percentage. Okay? Same thing with Tesla. Okay? It wasn't quite as much, but I'll show you how the trade worked this week. But this spread compressed as well. But remember too, Stan, if you want to trade weekly time spreads, they're very conditional. Because if you think I'm just going to sell that forward contract when things are in contango and you get any kind of a weird move, you're going to have an immediate capital loss. Then you got to sit there and suck on it until the thing settles. If it doesn't settle, you have to close or adjust. So the whole point of this is wait till it's interesting before you do it. All right? So what I'm saying here is you're really you're looking at a Vega risk because you're still buying that back month option. Right? One of the things, what's the overall, let's call it the overarching volatility impression in the market right now? Would you say that's very high or very low? Meaning, is relative volatility sort of really high or is it really low right now? If you had to guess. Right? It's low. Right? Because a time spread is a net volatility buyer, remember, you want to be buying lower. So it's a better trade going in. Okay? So when I look at this first line, in a short premium position, theta risk or Vega risk is the question. So when you have a time spread, you really want to build on trying to sell that forward turn, having the vol fall apart, implied volatility fall apart, and that position disintegrate, and you close it. Okay? Vega per contract is always smaller, right? Meaning what? Okay. So a 1-point move in volatility in the SPY or in Tesla, right, means 17 cents. Kathy's saying relative vol in our case here, I'll show you, Kathy, is Vega per point. So in our example, 17 cents is one volatility point in the SEP 09. In the SEP 02, okay, 1 point of volatility is 3 cents. Okay? So right now, the way it's pricing, right, and this is actually after this Tesla's already compressed. I'm showing you basically what you're going to see as sort of the end result. All right? But what I'm saying in terms, do you mean the IV drop in the front? It's the IV drop in the back month that hurts you more. The IV drop in the front makes you money, right? But the implied volatility drop is, what I want you to see is, once you already get to the point where this Tesla spread is, and 1 point of implied volatility is worth 3 cents. Does everybody see this? This is your Vega number. The 200 strike is, let's go to even the 220 strike. Okay, there we go, 12 cents, right? I was about to say 3 cents look low. Here, right, a 1 point drop in volatility is 17 cents. So if you lost 1 point across the board, the position's going to lose money overall. Does that make sense? Because you're going to lose an extra nickel on your 220s. Right? Because remember, a 1 point drop in volatility, if the vol goes down equally on both terms, I'm going to lose 17 cents here. And on my O2s, on my SEP O2s, I'm only going to lose 12. I'm going to make 12 cents. So net I'm going to lose 5. So the second part of the weekly is you want to make sure you're not going to, that back month volatility that you purchase is not going to do what? Is not really going to drop a ton. Does that make sense to everybody? Okay, so essentially really what you need to make these positions work is you need that implied volatility in the term you sell to be relatively juicy, right? It has to be higher. Right? So a time spread, you can always settle right at the strike and make your money. That always can happen. Okay, what I would say is it's not normally probable. Right? How many times have you sold something at the strike a week out and it's landed there every single time? Because if you're doing that, you're not taking this class, put it that way. I think I've had 20 pins in 25 years. Okay. Or it's possible you're just a lot better than me, which is fine. So anyway, what you want for our trade, right, is you want some kind of slow movement and declining IV that's usually optimal for short gamma. Okay, which is not, it's not exactly what we want here. We'll talk about earnings after this, SK. Okay. A time spread is pretty much the worst trade you can have. If you just going through what I just described to you, a time spread is about the worst trade you could have in earnings. Because of this, the Vega, the part that you're buying is just way too high, and you're short gamma, so it all blows up. You nearly have to. It's almost the only really time spread that might work is a diagonal, and you have to be near perfect. It's not the road to riches. Okay, so when we're doing the Greek review, meaning short gamma is generally the bigger Greek risk in weeklies, almost always. Okay, and the theta dollar is what you're trying to collect. What you're trying to do with a weekly spread is you can control the short gamma to a degree by pushing the terms together on a time spread. Meaning, if I'm looking at my sigma and I sell this guy here, the SEPO2, and I buy in October, I have massive risk to gamma, massive, and to volatility. But if I just trade the SEPO2 versus the SEPO9, I have reduced my risk hugely and really try to isolate the fact that I want that forward one to collapse. Okay? The tighter the distance between the terms, the lower the gamma. And the cheaper you can buy these time spreads, dollar-wise, the better it is. Okay? Outside of earnings. Now, okay, so I've already been doing this for about an hour. We're going to stop here, take 5 minutes, and then we're going to go through these positions at the end and then do a slider. Right? Now that hopefully you've learned something about how a time spread looks, we're going to start to work through the positions from that point of view. Does that make sense to everybody? So SK, you have to think about why. Remember, because you're long Vega, and before earnings, Vega is about as big as it's going to get. You're putting yourself to huge relative risk for the position. Well, good. All right, I will start again in 2 minutes, okay? Okay, so now I want to use some of what we just talked about and placing a time spread, right? The ideas of, these are prices I pulled from this week. Stuff that didn't make it into our strategy letter. Actually, I wish they would have, because they all would have made money, but you can't always pick everything perfectly. However, but again, the exact same conditions we talk about here are the same stuff we talk about in the chat room, and how we talk about things in the gold course, and all, right, how we run our fund. It's all very similar related stuff. Okay. What we're doing, though, is we're taking the parts depending on what we're actually looking at. So what you're looking at now is, right, theta is a benefit from short gamma, meaning if you sell options, you're going to collect something, and that's what, like they just heard earlier, that's what all the gurus sell everybody. Okay? There's really no edge in doing that unless your implied volatility is due for a change. If your implied volatility is going to collapse, meaning your short front month against your back month is going to fall, is going to drop, what you pick up is what we'll call accelerated decay. Right? That front month drops really fast and the position makes money. Once you have that happen, what do? You close. Okay? So when I look at this, you're setting up a weekly time spread, right? What am I doing? I'm looking at my shorter term implied volatilities. I want to figure out what the story is for, and again, ETFs like XOP, XLE, TLT, GLD, SPY, IWM, Qs, right? These lend themselves better to those types of trades because the gap risk is usually less. Okay? So if we make a chess list of things to consider: time to expiration, IV term structure, time to earnings, shape of the skew curve. Yep. Well, what's funny, Mike, is those are all functions of the option model, right? That's why we do the gold class. So you learn the option model, and you learn how all those things, the option model affects all those things. Because he's saying, okay, time to expiration, term structure, right, earnings, shape of the curve. That's why we do all that. Right? Because you want to know how those things work. Right? That's why you have to learn how those things affect the input price of the model. Right? Because ultimately, when you think about it, is you are trying to figure out what the inputs to the model are. Right? Like, what's that stock price going to do? What's my volatility going to do? Right? Am I picking the right strike? Right? Am I picking the right time to expiration for what I want to do? Right? Those are all parts of the model. Does that make sense? So here's a couple things for setting up why is the Tesla trade. Why I'm like, Andrew, why are you even looking at Tesla? Okay? The first part of the reason why was Tesla just had earnings, and the implied volatility was what? So this red line is 30-day implied volatility, which looks out 30 days forward on an average. And do you notice where that is? Where is that? That is a 6-month low, right? So when I see that, I know that if I buy a time spread per se, what I'll call my risk to a lower volatility? Would you say that's a very high risk or very low risk? That's right. What's my risk for buying implied vol? It's relatively low, right? So remember, if you can put on a trade where you can start controlling parts of the risk, doesn't that mean that trade has a better chance of success, right? A perfect trade is if you can control all the risk and have edge and you can't lose any money, right? So right now I know that because buying a time spread, even a weekly time spread, has that Vega component, I want to start when the implied volatility is already where? Low. Right? That's why right now I would say Tesla is at least for the very short term, because they're doing this weird thing with SCTY and the stock really hasn't gone anywhere, right? It's not normal for this stock to be like this. Do you want the IV in the front week to be more or less than the back week? I want it to be more, and by what percentage? I want it to be just enough generally. You remember that original green line, Trevor? If it's too high, what does that mean? Right? Do you remember that slide? I did that for a reason. Remember that one line where I said you guys aren't going to understand what this means? If you're too backward, what's the market saying? If your term structure is too right, it's like who knows where you're going to go. If you're just a little backward, though, it's just because you've got a little move from a low vol environment. Does that make sense? So all you're trying to pick here with the weeklies is you're just trying to pick a small move, not a big one. Right? You don't want massive trading risk. You want small risk. Okay? So what I'm looking at, I don't want to take a lot of Vega risk, meaning I don't want to buy high vol. Time spreads are usually poor, high volatility environment trades. So normally for at option pit, mostly zone 1, sometimes zone 2 for VIX. Okay, which basically is just that's the low end of the curve, the very low end of volatility. You want some edge in term structure if you can. Okay, you don't necessarily have to have it, but it makes it nicer. Right? Because if things drop into contango, even if you do something at a flat vol and things drop into contango, what's going to happen to your front month? It's still going to go down, right? Which is helping your position. And that's when the Vega risk is worth taking, right? And you can. So the thing is, you want to just measure it. Okay? See, you have my fancy pillow here. But what I'm saying is your term structure edge is kind of a cushion for the position. So the Tesla trade I showed you had a 2 short delta, 9 short gamma, but your vol risk, if vol goes down 1 point, it's going to cost you $25 a day. However, your theta is $31 a day theoretically. So even if the vol goes down 1 point, that's going to wipe out 1 day's worth of decay. If you don't have any drop in volatility net, you're going to collect the theta. I did. I embroidered that pillow especially for you guys. So what you're trying to set up with these positions are, if I put it on, what's my risk? And generally I look at, I want my theta dollars to be relatively positive to my Vega. That tells me that generally I'm trying to buy low enough volatility. Okay, because if you have to take a big Vega risk, but you're only collecting like $1 a day, you better have a better reason for the trade, because you're not making any money. Okay. So what I want to show you is like, yeah, the term structure changed a little bit. 26, it was about 50 cents, and it closed to around 30. If you get 100% on all the quizzes, SK, I might send you a pillow. So what I had is I had a small change in the term structure for Tesla. It's not huge. I think the biggest part of why we didn't do it, there wasn't tons in this trade. Okay? But I didn't want to show you how the price changed, right? So a 2-day maturity. Now remember, I was looking at purchasing, we first saw this, I was trying to get 115. I didn't get it. It was my bid. Probably traded 120. But 2 days later, the price of the spread went from basically 120 to 136 to 143 to 149. Okay? In 2 days. Stock moved about $1. So you got a pretty decent. Was it, a home run? No. But for a weekly, it did what I actually wanted it to do. Okay? Can you relate this to the Tesla chart? IV was low and unlikely to go low. It was. But remember, the IV chart, John, is 30 days out. And we are trading what part of the curve here? 2 weeks in. So that vol chart is giving you a relative sense of where things are, right? So remember, you have your 30-day vol, which is looking 30 days from now, which is what, near end of September. So you're saying, wow, that's just telling you options are already pretty cheap. So what you're looking for is the little wiggly part of the curve and the term structure for your weeklies, right? And when I mean wiggly, that's that front part of the curve in the green and red line. That's why I draw those, right? I think that's a good visual for how the term structure works. Okay. So, closing these types of positions. Right now, vol is cheap until September is correct. You can buy all the September volatility you want in pretty much any product on the planet for 1-year low prices. The problem is the market hasn't moved in a month. So I myself, I've been buying October and January volatility. You know, I'm barely paying for it right now. So if we move a little bit, I should do okay, but that's what I'm doing. So anyway, as the front month IV starts to drop, the position should be gaining, right? So the key thing is about, this could be a day trade. You get the front month pops up, you sell the front, buy the back, you get the collapse, and you're out. So I don't understand your question. So the vol provide in August is for September. So remember here, right? Now remember, let's look at Tesla one more time. Okay. Oh, they're going to give me a chart. They give me a chart. Come on, give me a chart. Give me a chart. Okay. Oh, they did give me a chart. Okay, you see this? Here, hold on here. Let's get rid of the 20-day realized vol. Okay. This is showing you 30 days from now where the vol is. That's where it's priced. Okay. Here, that would be right here. Notice the vol is around 28. Okay. The very front part of the curve, 2478, totally collapsed. Right? By the time the end of the day. Even more so than the snap that I took midday. So they're showing you out here, but the vol has gotten as low as 25. When I snapped our picture for Tesla, okay, right, it was still 27. Right, that was midday. It dropped another 3 points in the front. By the time the end of the day, that's why the spread picked up so much value. Okay. Like I said, Mike, symbols to trade are ETFs, SPY, right? The cash indexes, bigger ETFs, and I would say equities. And at the end, I'm going to show you a technique to trade equity weekly. Okay. Okay, because he's saying as we get started, you have specific symbols for weekly. Like I said, the best weekly calendars are generally in the indexes. Like sector ETFs, exactly. Yep. But you have to wait until there's what? Something interesting to do. Because if you just try these times, you don't get paid anything for them. You have to take the risk of a time spread, and you got to wait all week to make any money. That's usually the problem. You put on a weekly time spread, like, oh, I'm going to get this decay. These front month options are going to go away. And they don't really evaporate until the very last day because you sold the vol for so low. So you take the risk for a week, and you have no chance to make money until the last 2 days, right? Which I hate those types of positions. Okay, so leaving the position on the last minute expiration day will expose you to a lot of risk. So you're looking for ways to things to happen, right? Things to happen meaning the vol moves around like I showed you, comes in a little bit, close the trade. Thank you very much. I'm done. Okay. So, right, you're starting with IV that is already lower. So here's the checklist. Post earnings is a great time, right? Most of our traders that are putting positions on a lot are looking at time spreads and short vol trades after earnings, right? Because the big news is already out. The big potential move of the underlying is less, okay? Following an index IV crush, okay? You want a good time to trade these weekly trades? One of the better times is you get a big rally in SPY like we've been getting, and they totally crush the implied volatility. You buy a put time spread slightly out of the money looking for the back off. Okay? Best time to trade put time spreads in the SPY. Because they crush the implied volatility. It gets you slightly short delta, not a ton. Still gives you room if the underlying goes up. But if you get just a little bit of a pullback, they do great. Right, so you're looking for like real specific times for these. Again, remember, we're talking weekly time spreads. Right? A backward to flat term structure gives you a head start. Right? That's just like we said, the gray line or a gently sloping up green line. You don't want crazy backwardation because the market's telling you we're moving all over the place. You don't want that. And you're trying to pick a spread that gives you the most room, meaning you want to spend little dollars to give yourself a bigger tent to make money. Okay? So, right, is this the end of the story, right? Your time spread can be set up with a directional bet in general delta, which I'm going to give you an example of the TLT that we have in the strategy letter, which I like this trade. Don't forget, though, the nearer the money you put the time spread, you have less directional bias. Okay, there's less. Doesn't mean there's none, but there's less. If you put time spreads way out of the money, they're very directionally biased. Okay? So, if I'm looking at Tesla and I trade a time spread that's the 230 line, I'm net long delta. If you trade anything near the money, you don't want it to move too far away from the money. And if you put it out of the money, the put-wise, let's say the 210, you're a little bearish. So don't forget, wherever you put your long time spread, buy the back month, sell the front month. Wherever you put those strikes is where you want the underlying to go. Does everybody get that? Where you put your strikes is where you want the underlying to go. It's like a magnet. Usually you have one or two. He's asking, after earnings, I think there's usually some residual IV, but how long does it take to diminish? It usually takes a couple days. Right? Again, there's no guarantee there's a trade there. No guarantee. But what you're looking for is what? You're looking for a little bit of backwardation in the term structures after earnings. And you calculate what you can make. Does that make sense? If it's there, yes. But if it's not there, you're like, it's just not worth it. In a directional trade, the short is mostly to finance the trade. Andrew's asking a directional trade. Yes, but don't forget too, Andrew, if you sell that option, you want to be paid for it. Meaning, because sometimes if you sell that if you have a time spread that's directional, you sell the forward option too cheap, you actually, if you get the rally, you make very little on the spread because you sold the front month option for such little money. You're like, great, I just got a $3 move and I made 25 cents on my spread. Fantastic. And your whole point was to be long in the first place, right? You weren't looking for a vol trade, you're looking to be long. So what I would say is, if you want to be long, find the best way to do it. I'll do it at the end, Trevor. Going over backwardation. Okay. Backwardation is just, remember, the green line, which would be, because I don't want to run too far over my time here. Okay. Backwardation is the green line. 19 vol right? This is 19 vol. So on this axis, 19, 18, 17, 16, 15, 14, all the way down. The steeper, if this line looks like this, okay, if it looks like this, what's the market telling you? Okay, if it looks like this line here. What's the market expecting? Let's put it that way. It's loud, and loud means what? A big move. Do you want to sell gamma into a big move? No. You want to sell gamma into a little move. Do you guys remember that? I don't know if you had kids, but the loud, quiet book, right? You want to sell gamma into, noisy, not loud. Okay. This is just to find out this front month volatility here would be, relative. It's like 25, really high, 25 over 17. That's a huge number. Okay. So, does the implied vol matter with so little time? It matters because if it compresses enough, it generates the dollars to make it worth spending money. So if I'm going to spend 40 cents or $1 on a time spread, if I think I can really make 50 cents with forward vol compression, that's like a 50% return. Those are the types of dollars I'm interested in. So if I'm spending $5 on an SPX time spread that looks really cheap, that should go to $7 in 2 days because of compression, that's interesting. That gives me one full standard deviation of movement on break even. Okay? So what I'll say is trades have different shapes to take advantage of market conditions. So Mark talked about butterflies working in a certain way. Okay? Time spreads have term structure, has to really be a certain way. So what you're trying to do is we go through the gold class because flies work better in certain areas, time spreads work better in certain areas, condors work better in certain areas, right? You can modify all those things to help kind of fit. Okay? But what you have to understand is understanding the conditions that make things work is an educational thing. Or where Mark and I learned the hard way, and then we said we can tell you if you buy a time spread in high vol, it doesn't work because we lost money doing it. So then I just try to stop doing that. Okay? Okay? So remember, yeah, I know. Usually we get most of our clients because they've tried other ways and they're like, okay, well maybe we'll try this like risk control way and see if I like this better. Right? All I'm saying, these are a couple of relationships. You can have low implied volatility and higher realized vol. That's possible. The market can price things like that. Okay? Okay? You can have higher implied volatility and very low realized vol. That also is possible. There are all kinds of relationships between realized vol and implied vol. Realized meaning the underlying is moving a bunch. Okay? The implied volatility is moving a bunch, or it's not moving at all. So what you were trying to do is find, if you look at a product, if you look at the SPY, whatever you look at all the time, if I'm going to trade weekly time spreads, when do I care about them? Okay? In the example you had, IV starting off at 9.25, does the market expect to go to 17? What it is saying is, right now we're expecting realized volatility to be very high, but it's going to decline over time. Okay, so to me that means another type of trade. Maybe I want to be long gamma somehow. Maybe we have to figure out a way to own gamma, right? Because just because the IV is 25 here, it doesn't mean the realized vol is a bunch higher. Normally, when you see a curve like this, that means realized vol is much higher than it's showing when it's this steep. Okay. So we're just coming to the end. So if realized volatility is very high, in general you want to buy weeklies. Usually you want, Mike, when you sell the weeklies, the term you sell, you want about at least 14 to somewhere between 14 and 9 days. That's about a sweet spot for if you have enough of a lift where the crush is good enough to make it worthwhile. So I was looking on Wednesday for the SEP 0209 Tesla spreads and the SPY time spreads. That was this Wednesday. It's about 9 days of hold for the short 02. Does that make sense? Because that's giving you basically, because you want to kind of hold it for a week and then be out of it. You don't want it to hold it to the very end. You want to be done, if possible, the week of expiration. Right. Especially you need some time, but you want the stuff to compress. Okay. What's important, right, is you have to have, if you're going to trade these things, you have to have some idea of realized vol, meaning, what's going on with underlying vol. If you're going to sell options into a highly volatile environment, it's very hard to make money because the compression that we saw here, right? Put it this way. If realized vol is going up, meaning the underlying product is getting more volatile, you're not going to get the move from the green line to the red line. You only get the move from the green line to the red line when what? The vol drops. Okay. I was under the impression that high vol options are expensive and vice versa. The problem with that is Dennis, is they don't talk about relative to realized vol. How much is the underlying's moving? So I'm saying, does it mean if the implied volatility is high, you just go buy it? No. What I'm saying is, if realized volatility is high, meaning, right? When I say realized vol, let's look at this. Okay, if we look at the SPY, okay, and we look at the B, let's go 6 months, and we'll go beginning of the year. So when realized vol is exploding like this, right? You see how the blue line is 20-day realized vol. Do you think you made any money selling options here? Selling iron condors? Unless you sold puts at awesome times, what happened? What happened to you selling options? You got your butt handed to you, right? So what I'm saying is, you need, if the realized vol expectation is kind of low for short periods, that's when it's optimal. But if realized vol is really high, I'm looking for ways to try to buy them. And there's all kinds of ways to buy something without actually having to pay for it. Right? And I'll show you an example. Does that make sense? Right? Because if you just sell high vol options, right, usually volatility is super high for a reason. What you want to find is overpriced options. Right? I think that's what people mean when they say selling it. You want to sell what you think is overpriced. I look at where realized vol is, where the skew is. I need to be able to buy something cheaper than I sell. That to me is overpriced. Okay. Does that answer that question? Calls, they say, for the non-directional time spreads, it doesn't matter calls or puts. The only thing that matters might be a dividend. What does it mean when the realized vol is higher than IV? Okay. What this means is, right, and this is something we do more in the gold class, but when you have realized vol this high, that means the market is consistently underpricing the at-the-money straddle, right? Because remember, Well, do you understand now, Dennis? You say no, it's totally me all day. What you're looking at, remember, overpriced options. Overpriced relative to the move. Right? So when realized vol is this high, remember, the market is implying, let's say, a $3 straddle move, but the underlying is giving you a $6 straddle move. TOS does have a realized vol line, a historical vol line, Mel. You have to go on their charts and look for it. It's under volatility. Let me see. I think if I look at it 1 year, I'll do that at the end. I want to get to this last part. Okay. So what you're saying here is 60% vol. Okay. I believe this example was a Tesla example, right? Super high volatility. This is just high vol on earnings. But what this means is, don't forget, your at the money straddles are telling you an implied vol move. Okay, so Tesla right now on the 6-day straddle, okay, it's telling you, let's get the implied vol up here. Okay, it's telling you right around 24% volatility at the 23% vol at the money. All right, 23% vol. So if the realized vol is trading 40, do you think that straddle is cheap or expensive? Okay, if the implied volatility right now is 23, but the realized volatility is 40, do you think that straddle is cheap or expensive? It's cheap. Okay, now let's do the opposite. So this was for Dennis's question on this. If the implied volatility is 80 and the realized vol is 20, is that straddle cheap or expensive? It's expensive. So what you're trying to do is, okay, I want to sell it, but I got to figure out a way to manage whatever the risk I'm selling. Does that make sense? The whole idea with weeklies is they're very risk-controlled trades because you're just taking very, very small relative risk. Right? Even if the underlying has a big move on a weekly time spread, you don't lose a lot of money. Right? So, okay, I got to make sure we get to this part. So the explosive and relatively permanent nature of gamma in weeklies. So what we're saying is, because weeklies expire, you don't have a lot of room to be wrong, right? You don't want trades that you're going to lose all your money in a weekly. I don't understand your question, Trevor, with both reverting to the mean. It's very possible that during the time you hold a position, you don't get any mean reversion. You get gamma, right? Where the underlying moves a ton, right? Or it doesn't move at all. Remember, mean reversion is not just some magical thing that happens all the time. It's over a period of time. That's why, time and strike selection, all that stuff are important. Because you want the things to happen while you have the options that you own, right? If it happens a week after you close, it's not helping you very much. Okay, so one reason why these are interesting positions for us is because you've got a little less risk for the trade that you have. It doesn't mean there's no risk, but generally it's very hard for a weekly time spread and an index to go to zero. It's hard. You need to have an enormous move to make that happen. Okay? Doesn't mean it can't, it's just harder. So you're looking for potential trades where you have a better shot at making some money and less of a chance to lose a bunch. Right? That's the kind of stuff we like. Okay? Just a simple rule for debits and credit spreads if you trade weeklies. Okay? If you want a credit spread, you work as far away as you can. Meaning, if you want to sell stuff and you want to, that's the thing that you want to do. Get as far out of the money as you can. You can never be far enough away. Okay. If you want to buy anything, you always want to work closer to the money. Okay. Just a general rule with weekly debit and credit spreads if that's what you want to do. But this is, if I have to give you one blanket rule, that would be it. Okay. The only time I sell credit spreads is when I want to take a delta. I think for the most part, credit spreads are like the worst things to trade. We almost never do them. It doesn't mean there are people that are good, but the best traders that we have in our room like rarely trade them. The times, what I do is the stuff we do for credit spread, Mike, mostly is a controlled credit spread. Like I'll sell a put spread in the SPY and hedge it with VIX and you make some percentage return, right? Our fund, we do something like that. But just to sell a credit spread without having some kind of hedge, it's hard to do that. You know, it's just hard. I like to say it was easy, but it's not easy. If I've seen somebody do it well for a long period of time, I just haven't seen that. I've seen guys that kind of trade iron condors, but they manage the gamma. It's just to sell a call spread all the time, and you know it'll work sometimes. It blows up sometimes. It's just what it is. Okay, so remember, just if you're looking at credit, they want different things from the market. So you have to be selling a credit spread into a high vol market, tough. You get more volatility, but you also have that realized move. So one thing we try to get people to understand is, you know, if you sell options, you want it to outperform. Outperformance means the real underlying market for whatever you're trading just doesn't move a lot, or it doesn't move as much as the options say it's going to move, which happens all the time. And the weekly time spread is just a good vehicle for that. Okay. Now I want to get to, I got to hurry up because I want to get to the last thing. Okay. The thing is, giving some risk control, meaning you keep a limit on credit and debit spreads. What I will say is, I like those trades when I can hedge them. I don't like rolling losers because people I'll just keep rolling up and rolling up. Right? If you keep losing, it's easier to close and re-enter than it is to just keep losing or rolling a loser. All right? What you can do is you can turn a double calendar, you can turn a time spread into a double calendar if there's still some term spread edge, or term structure edge. What does that mean? Right? If I have my Tesla spread, which and I want to get to my slider idea here. There we go. I have this spread. Let's clear this parameter. Okay. So I have this, and now what I'm going to do is, okay, so I've got 220 here, and I'm going to go down to 210. Okay. And I'm not recommending this as a trade. I'm just saying it's a way to change the risk profile. Right? Here's my spread. Right? The reason why you do a double calendar is because you want to move out your risk profile a little bit. Okay? So I'm not going to cover short calendars today, Mike. We do that in like our gold class and stuff. But yes, the short calendar is when you have the opposite happening, meaning I'm expecting the volatility to do what? Generally, a short calendar is for when the market is the actual opposite of what it is now. Vol's very high, things are very crazy. So the short calendar is exactly the opposite condition for a long calendar. Does that make sense? It should make sense. But I'm not going to cover that. Okay? So I want to get to the last idea here. You don't fall in love with a P&L. As soon as you make money, you close it. Right? If you sit there, right? What I do with a calendar is I do this. Okay? You most likely, if things go well, you are only going to get half of this money. Okay? You're saying, "Wow, I'm going to make like $1,200. What are you talking about?" Okay? Unless you pin directly at the strike, that's when you make all the money. Okay? If things go well, you've priced the forward well, you might make half of this, and as soon as you get there and you have the vol crush in the front, you close. Okay? If you look at this thinking you're going to get all the money, right? Anybody can put a trade in here and have a peak profit. Do you think? But that does not entitle you to get it. Do you understand what I mean? There is no entitlement, right? Anybody can put on anything that has peak profit. So you don't fall in love with the money. You get reasonable targets and you close. I'll just say always be closing these positions. Okay? You can roll a short position, meaning I close the short and I'll sell another one. That's fine. Okay? But if you're a winner, not a loser. Okay? So when you set these up, you get the story from the term structure, meaning what's going on. It's giving you a picture of what the market thinks of realized vol. Okay? Understand what your Vega risk is going to be so you can calculate it. Does the risk reward look decent? Can I make really good money on this time spread if what happens, what I think is going to happen, is going to happen? Have a routine established, meaning if I get to the outside of the tent, either way, am I going to close a roll? Am I going to close or add basically one more calendar? Adding another calendar is okay as long as you improve your risk reward profile. Okay? As long as there's edge there, meaning the reason that you sold those calendars and to put those calendars on in the first place is still there. Right? Because if you already get the reversion, put it this way. So think about it this way. Okay? You have your green line and you move to the red line, but the underlying moves so much you didn't make any money. Okay, that's possible. Should you keep the position? Green line moves to the red line, but you didn't make any money because your underlying moved way too much, which happens. But you didn't make any money, you didn't lose any money. Do you keep the position? Kathy says no. She gets a gold star for being first. Since the expectation you had, everything kind of happened, but you just got too much movement, there's no reason to keep it. Close. If the worst thing you did for the rest of your life trading options is to close things for even, you're going to have a very good time trading options. Don't try to pull more from a position. And sometimes I get into the same problem. I'll stretch something. And as soon as I hear myself saying that, I know I should close it. Okay? What I want to do is show you a little slider position from TLT that we have on our strategy letter. I kind of like it as an example. The term structure is still favorable for it, which is why I thought about it. You got the SEP 2, you got the SEP 9. This stuff's a little bit. I know this is compressed because of the holiday, but the 14 vol looks high for me. Okay? So this is what we put on. Right? A slider is just a time spread with a hedge. Okay? So again, TLT fits what we want it to be. Let's reset. I don't think I made $500 yet. There we go. That's a little better. Okay? So what I have is you have a time spread. Okay? There was a lot of edge in the time spread. Notice the price of my time spread when we had, that was the initial price when we had pretty decent backwardation. I bought the 144.5 call spread for only 23 cents. Remember, you're looking for the spread to expand in value. So if you want it to expand in value, you got to start with tiny dollars at the beginning. Right? If I'm paying $1.50 for this, that means it has to go to $1.60 for me to make money, right? But if I'm paying 23 cents and I get another dime, 15, 20 cents out of it, well, I can make some money doing this. Okay? Part of the assumption is, yeah, the Fed's going to lower whatever, but all I know is treasuries haven't sold off in a long time. Okay? So my realized vol expectation is what? Low. However, I am not dead to the fact that that could happen. So what I do is, here's where my risk point is. Okay, I will just start by buying. We started by buying one put, and as soon as it dropped a little bit, I bought a second. Okay, so if we continue out of the risk tent, and we're down here at 136, and we're totally wrong, guess what's going to happen to us over the next couple days? What's the worst that can happen? Okay, we're just going to break even. Okay, so if everything happened opposite of what I thought was going to happen, I break even, I figure that's okay. If, however, we get the same thing that's happened every single time the Fed says anything, TLT sells off, and then it spends a little time rallying back up into where we are here, in 5 days, this is going to be worth $500. Now, here's the thing. I only have $600 into this right now. So I have a chance for almost the double on a time spread. I think that's well priced. That's why it's in our strategy letter. Right? And if we don't get the action we want in a couple days, we just kill it. And it didn't cost us anything. It cost us commissions, but we didn't lose real money. Did you guys see that? Yes, no? I know it was a little fast, but I was out of time. Okay? So the whole thing is, what do? Conditions. Okay? What are the conditions? What are the realized vol conditions? What's the pricing? What's the term structure? I'll hedge it at what I'll call a slider. I'll hedge it a little at the beginning because I want to try to hold on to it a little more. We said earlier it does not matter if the time spread was calls or puts, but on the slider, the reason why is because there's a dividend in here, Mike. Right? The near the money calls are not a problem with the divvy. The puts, a potential exercise after, I don't think so, but I didn't want to deal with the dividend. So the call spread. Also, the markets on the call spread here were only about 3 cents wide. The market on the put spread was like 15 cents wide per put. So I have a 6 cent wide market on the call spread. I have a 30 cent wide market on the put spread. Right? Better entry. So it's practical. Okay? What if you do open the put spread, put with the spread if you have a bias? You can change the bias any way you want. Bo, any way you want. My bias has basically been that the TLT is just because we were trading like right around here. So originally we set this up is if nothing happens, I'm expecting about $250. Nothing happens. And then I would close it. But we did get a slide. We just managed the slide. The front month volatility has come in a lot, which has helped, but it's still got a long way to go. Right? Because notice, here's the closing price on Friday. I still have another 1.5 for this thing just to get flat. Mike's saying I use the calls in this case to avoid the dividend. Well, you just don't want the complication of a dividend if you're trying to hold on to it. Because if you get assigned and then you got, then you got a deal. So what I do is I try to put, when you execute this as an idea, I try to lowball the time spread, put in a bid. If it gets filled, then I go buy the puts. Okay? How do I select the strike for the hedge? Oh, okay. What I do, Dave, is, it's funny because I was talking at I go to the spot where it sucks, right? This is where I'm out of my tent, and I want to buy those puts. Okay? I don't want to buy 135 puts because they're not going to help me. I want to go to the stinky spot because if we trade down here and then we rally again, I'm going to be fine, right? But if all of a sudden we just crap out, I want the puts to work. Does that make sense? Stan, how long would you wait generally after earnings to put on a calendar? You really have to watch how the vol is trading for the product, Stan. I don't have it normally probably 2 days afterward. Right? Or what happens is earnings have come out and then they crush the vol and you wait a week and then for whatever reason the stock moves a little bit, your front month jumps and then you can have a times for that. You put one on that if it's a weekly. Does everybody understand what I'm trying to do here? You might not. This is a lot of stuff for one class. It just is. Because if you've never looked at the market like this, you're like, what the frick, what's he talking about? But I had, right, and Mark had, we had lots. I didn't have weeklies as a market maker. Staying around 70%. Well, the good news is that I think I recorded it all. I hit the record button, so. But you're looking for certain things to happen. Right? But you're waiting till the pricing gets interesting. Right? Most people lose money on time spreads because they buy them at crappy times. Oh, it totally has the directional trade structure. So remember when I said you could create a trade that actually wants the underlying to move a little bit? Mike? What do we do? We created a trade that actually has positive theta that you actually I can make money from 141 down to 0. That's not bad, isn't it? How does the TLT have the potential to go to 500? The TLT is just the bond ETF. If TLT goes to 500, then the U.S. has negative. I don't even know how to describe that. Right? I'm putting the time spread up to where it really can't go higher than that, right? I mean, part of the reason is, don't forget the product is the time spread is setting up here where it'd be very hard for TLT to go much higher than this. So remember, I thought of all of these things when we set this up. TLT could go to 130. I think it's hard to go to 150. Doesn't mean it can't happen. It's just tougher. You know what I mean? Even when we had the total, how high did it get in the total meltdown was 143.71. We could actually handle that. We'd be down a little money, but we have a chance for it to slide back. Yeah. The thing with TOS is, I think TOS is great for people that are more like technical, they're kind of chart readers or short-term chart readers. Also, immediately profit from the down move, and like a put that has to exactly. So what you can do is you can actually, if the pricing is good, you can trick your time spread into actually giving you something that's got a little bit of a. You have a little positive. What I mean by positive curvatures, you can make a little money if it slides around, right? Oh. If things go well, my $23, I'm in the trade for 23 cents, Dennis. I'm in the trade for 23 cents. I'm up. That's cost me $4.60. I could make about $500 is what I'm looking for here. Right? What I'm trying to think is what's my reasonable profit potential, and if they crush that front month, is about $500. If I make that, I'm out. I thought you meant $500 is the underlying price. Right? So what I'm saying is if I have 500 in this, I want to be able to make $500. Right? And if we just do any kind of creepy crawly back up, I make it. If for whatever reason they crater TLT, we'll make some money and then, Oh yeah. Can you review the upside? If we rally hard and they crush the vol, I'm definitely going to lose. right? So what you would do is I would set the time spread up higher than this, Mike. Or what you do instead is you can buy a put spread, out of the money put spread, and buy a call. Right? You can change it around. Right? So it depends. You change the bullishness, then you have put spread versus call. But you still want to see what that looks like. We picked this because it was still a little bullish. Right? Because if we go, how many days we go forward? Boom, boom, boom. You know, if we just have a couple days in, it looks really good. I mean, you'd have to be way up here before I considered even buying calls, Trevor. Right? Because what would happen is that means all your assumptions you had are totally wrong. Remember, you'd only buy a call if it's worth buying it. Buying a call here, it's probably, since you're not going to lose very much money, it's just better to close it if you really think you're going to keep rallying, because then your whole trade concept is gone anyway, right? I wouldn't have put this on if I thought 143 was what, or 144, 145. So what I'd say, Bo, is just pick the most liquid names, the top 25, and just look there. Right? You don't have to look, just pick the top 25, and of those top 25, pick 5. Right? Because really you're just trading vol, you don't really care what the underlying is. You don't care that Apple's going to 500, you know what I mean? It's just, you're just trying to buy time spreads in Apple and see how that works. All right, is the primary goal to have flat gamma with a hedge of the current price? My primary goal actually is, you guys notice I have positive gamma and positive theta? I mean, my goal is always to have positive gamma and positive theta. I mean, I really like that. But you can do that by time spreading. And you can only do that time spreading if there's edge in the time spread, meaning you have this slightly backward structure, because the higher the vol is in the front, the less the gamma is you sell. So it gives you net more positive gamma when this volatility is higher. If that confuses you, it's in our gold course about explains how all that works. Okay, which, see, there it is. There's our slider. Now we're all done. Okay, use code SVOC if you want to learn about this stuff. Way over my head. It's not way over your head. Right? It's just how options trade. Any thoughts on the Greek ratios? Like I said before, Clyde, I want 1 day's worth of theta, if possible, to pay for a 1 point change in vol. If that helps. If that helps. Unless, like this position here, I'm not looking for, if the volatility changes a lot, then we're falling apart, I think. Oh, gamma the theta. Generally, I'm looking for twice the gamma to the theta. If it's a straight, but this has net contract, so it's a little different. Right? Because if you fall apart, it doesn't matter. Nope. The gold thing, Mal, is, yeah. There's another chat room on Monday where we just discuss specific things on Monday evenings for an hour. Usually it's about 45 minutes, and it's education, and it comes with the chat room. So you basically learn stuff, right? It's a full course about all this. Okay, but you also get all the Saturday, like all of our Saturday classes are free. They come with it. Plus you have access to all of our old Saturday classes. What time on Mondays? It is usually, I think it's 5 o'clock. We have a 5 o'clock, and I also record a lab on Thursday afternoon. 5 o'clock on Mondays. But we record all this. So you have access to the recording as well. Also, the rest of the gold stuff is all recorded, so you can just watch it at your leisure. Okay? But it's the most amount of option pit, the education chat, all of our Saturday courses, all of our gold content. So we record all of this stuff, right? So if you want to learn about VXX, right, and all of the vol products, okay, pricing, trading, there's literally 1,000 hours of information on here on understanding the Greeks, how these things work with Greeks, almost any subject trading options you can think of. Vol, that's all the content that comes with gold, all of our past stuff. So if you have questions about how things work, you just search for it, and there will be a webinar for it. That's why, we charge more money for it, because there's a lot of stuff there. All right? It's a good deal. It's what we sell the most of. Questions, comments? Hopefully you learned something. I enjoyed teaching the class. You guys asked a lot of good questions. Oh, as a gold member? So as long as you have a standard option pit, account, meaning once you're a gold, you're always going to be gold. If you pay for like the yearly access, which is Option Pit Live, which you would call kind of your maintenance subscription, which is $90 a month. Actually, if you've taken gold, it's as low as $75 a month. You have that. You have access to everything as long as you're a gold member, which is 4 months. So if you decide to do Option Pit Live, which after you take gold is only $75 a month, as long as you keep that subscription up, you have access to everything, all the gold stuff. Our guys, most of our pro traders or guys that trade a lot have a TOS account and a live vol account that uses Lightspeed. If you want, we can get you a preferred rate at live vol. Let us know. Send me a note at andrew@optionpit.com, and I will get you connected with one of their account reps. All right, andrew@optionpit.com. Oh, Brad, thank you. Also, Brad is one of our funniest guys. We have one iron condor trader, Stan, that's phenomenal. But he's extremely disciplined. But if things aren't going his way, he closes early. That's what I'll say with an iron condor. But 11 out of 12 sounds right, and you lose everything in the 12th. That is not. They're my least favorite trade. Although I like selling the gamma part, I only prefer to do them when the market is just good for them. To do them every month is very hard. I think you do better if you try them 9 out of 12 months when you actually have a pop and vol to trade. But just trying to make money, it's very hard, Right. Oh, no problem, John. I mean, if you want to, you can. If you want to do Option Pit Live for a year and get a gold deal, we'll work something out. So we'll just stretch we'll stretch your time if you want. If you do the gold class, Mel, depending on what you spent already, we can rebate you 4 months. I don't know what you signed up for. But if you do the gold course, we'll rebate if you spent some money on like just one class, like one primer class, or you've given us like $200 or $300 for Option Pit Live or something, you can roll that in. Yeah, you could roll this in. I don't know how much you spent. So he'll credit you generally what you spent. A lot of our clients actually pay for our membership by the money they make. You would be surprised. All right, you guys. Again, send me a note, andrew@optionpit.com, or send a note to Mark at optionpit.com if you want to order something. If you spent money and you want a credit or something like that, okay? Because he's ultimately going to make the deal for you anyway. I don't really deal with any of the credit card transaction stuff. That's all him. Okay? You guys have a good weekend.